This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bull channels. It's important to diagnose a channel early because then you have more profit potential. Also, in a broad bull channel, since the market spends so much time in trading ranges, bears can sell rallies, betting on reversals down that go far enough for at least a small profit. It's still a bull trend, so bulls should always be looking to buy. When the market does break out to a new high, the follow-through is usually bad. Therefore, you get a swing down, and that's what creates the channel. Every new high, you get a reversal back down. This is a 5-minute chart of the euro versus the dollar, and we're making higher highs and higher lows. You have strong bull breakout here, consecutive bull bars closing on their highs, and then again here. Here we have 3 consecutive bull bars. The market's always in long here, and this reinforces the always in long. At this point, you know the market's either in a bull trend or that this is a bull leg in a trading range. And if it's in a trading range, you could have a deep pullback. If you do have a deep pullback, then it's either in a trading range or a broad bull channel instead of a strong bull breakout pullback and a tight bull channel. This tells us that it's either in a trading range or in a broad bull channel. If you get a pullback that is this deep, it's not going to be a strong bull trend. It'll be a broader bull trend, not a tight bull channel. There are times when the market's in a broad bull channel when the market is always in short. If you start to get a series of bear bars, 3, 4, 5 consecutive bear bars, the market's always in short. However, it still can be in a bull trend. You can have a leg within a broad bull channel that goes down for enough bars to make it likely it'll go down further, which means always in short. However, the big picture is it's still making major higher lows and therefore is still in a broad bull channel. Here we have 5 consecutive bear bars, a tight bear channel, but the bear reversal still has not yet broken above the bottom of the bull breakout, and therefore it has not fallen below a major higher low. Traders see this as always in short, maybe here, but they expect that it's probably not going to go much further. Unless it breaks below here, chances are it'll go down a little bit more, but not much more, and then reverse back up. Here we broke below the bottom of the bull breakout, but not below the bottom of the bull trend. Always in short, we even got a second leg down to below the bottom of the buy climax, which is a major low, but we did not get below the bottom of the bull trend. And we reversed up very strongly, and this bar is telling us that the market is still in a bull trend. Yes, we fell below this low, which is a fairly major low, but we did not fall below the bottom of this entire bull trend, and therefore this might be telling us that the market's in a broad bull channel. We have a higher low here. Is this a major higher low? Well, fairly strong breakout to a new high, but the leg began here, so this is probably major and this might be minor. And you can see we fell below this low and found buyers. It did not fall below the bottom of the entire bull leg. Scalpers looking at these 3 bear bars would say, well, it's probably always in short, at least enough for a scalp. But if you're looking for swing trades, you do not have to get out of longs as long as it's staying above the bottom of the most recent strong bull leg. We're forming higher highs and higher lows. We're getting very deep pullbacks. And when a trader looks at this, they can conclude correctly that it's in a broad bull channel, but it's also mostly in a trading range. And that's always the case when the market's in a broad bull channel. It spends a lot of time sideways and it looks like it's in a trading range. And it is in a trading range. And because it's also both in a broad bull channel and in a trading range, you can trade it either as a broad bull channel, holding longs with wide stops, or as a trading range, buying reversals up and taking profits above prior highs. If a bull did exit on the way down, even below, let's say, this bear bar from this lower high, he has to get long again, because as long as it's reversing up from above the bottom of the most recent leg up, it's probably still in a bull trend. And therefore, if a bull got out here, he's got to buy again either above this micro double bottom, this bar, or above that bull bar, if he's trading always in. Usually you need 3 pushes up to conclude that the market's in a broad bull channel. When you get a third push up, you often get a wedge. Here we have a wedge, but this breakout is too strong for traders to sell. However, here we have a second entry sell with a bear bar, a pair of bear bars on a micro double top. This is a better short. And if a trader is long, it's reasonable to get out of longs here. Very often when you're looking at a chart, it's not clear. You can't tell if it's a bull trend, a bear trend, a trading range. A lot of times it's all three. Sometimes it's a bull trend, a trading range, and a bear trend at the same time, and the market is simply looking for clarity. Here we have a double bottom with a good-looking bull bar. We went above the bull bar and immediately reversed down. But then the bear breakout reversed up, and it reversed up a second time here. Traders will buy the second reversal up. They might not buy the first reversal up because this doji bar does not look strong enough to reverse that bear bar. However, once you get a second or third reversal up, traders will start to buy either above this inside bar. It's an IOI. We have an outside bar and an inside bar. So we have inside, outside, inside. Or some traders prefer only to buy above bull bars. So they would buy above the high of this small bull bar and then get filled here. What's the probability that this is the start of a bull trend? Not high, maybe 40%, maybe less. However, once you get this, and especially once you get this, a pair of very big bull bars closing at or near their highs, the odds are high that you're going to get at least a small second leg up, and you might be in the early stages of a bull trend. At this point, you think it might be a tight bull channel or a very strong bull trend, but it's possible that it's a broad bull channel and still a bull trend. If it's a broad bull channel, it can have a very deep pullback. As long as it stays above the bottom of the bull trend, the bulls have a chance that this will become a broad bull channel. Higher probability buying here or buying here. This is a higher probability buy. Some traders would get out here or below here, but other traders would use a stop below the bottom of the entire bull leg. All three are reasonable, and if you get stopped out, traders will buy again on a reversal up. Remember, strong bull breakout, high probability, 60% or more, that we'll get at least a second leg up. But sometimes the second leg up is small. This is a low too short. Some traders might call it a wedge, 1 pullback, 2 pullback, 3. But with the strong bull bars here, and then here we have 5, 6 consecutive bull bars, some closing on their highs. This is unlikely to lead to a bear trend. It's a low probability short, but an okay short as long as you hold for a reward that is at least 2 times your actual risk. The actual risk was small if you sold below that bull bar or below that bear bar, and the sell-off was many times greater than your actual risk. Traders wanting a higher probability short will wait until there are 3 or 4 consecutive bear bars and then sell closes, like maybe the close of this bar or this bar, looking for at least a small second leg down. We probably are always in short for most traders by the close of this bar. That means most traders believe there'll be at least a little bit more down. Even though this is always in short, it reversed up strongly from a higher low, and therefore this is possibly the early stages of a broad bull channel. Some traders would buy above this small bull bar, hoping that it's a wedge bull flag, 3 pushes down, 1 pullback, 2 pullback, 3, and a micro double bottom. They're also hoping that it's a higher low and the start of a bull trend. If you take this buy, once you get the close of this bar, you put your stop below the low of this bar. If you're right, and this is the beginning of a swing up, it should not fall below the low of this bar. Initially, if you buy above this bar, we don't know if it went above this bar, below this bar, and then up again, or if it went below and then up again. If you buy above this bar, a lot of traders will put their stop right below if they're scalping. If they're swing trading, they might allow for one more leg down after 3 bear bars, 1 pullback, 2, and they would use a wider stop here. In general, whenever you have a small buy signal bar, if you use a very tight stop just below the bar, you have a low probability trade. Tight stops have a high probability of getting hit. When I buy above a small bar, I usually do not put my stop just below the low of the bar. I look for some other location to place a stop. For example, below the bottom of the bull trend, because too often the market will go above the small bar and trigger the long, quickly go below the low of the bar, and then go back up. And I don't want to get stopped out. If you did not buy on a stop above this bar, you could buy the close of this bar, or you could buy with a limit order at the low of this bear bar. You can look at it as a bull breakout of a bear channel. A bear channel is a bull flag. We have a bull trend. We have a strong bull trend here. We have a bear channel, so it's a bull flag. Even though it pulled back below the bottom of this spike up, it's still a pullback from this spike up. It's certainly a pullback from this entire bull trend. And therefore, this is a breakout of a bull flag. Chances are, when the breakout is that strong, you're going to get at least a second leg up, probably some kind of a measured move up. Buying at the low of this bar makes sense, or you can buy with the stop. We have an III, a series of 3 inside bars. You could buy with the stop above any pullback bar, for example, above the high of this bar, looking for a second leg up. Maybe leg 1, pullback, leg 2, or leg 1, pullback into a triangle, leg 2. A triangle, buy with the stop above its high, looking for a second leg up after such a strong reversal. I said that when the market's in a broad bull channel, it's often in a trading range as well. And in a trading range, traders can buy low, sell high, and scalp. And therefore, if the market is both in a broad bull channel and a trading range, traders will look to sell rallies. Some bears noticed that when the market went above a prior high, it came down enough to make money. Also, they see a very deep pullback, and they conclude that either the market is in a trading range or a broad bull channel. In either case, if you sell at or above a prior high, the market will reverse down enough for you to make money. Five consecutive bear bars with 4 closing below the midpoint. Strong selling. And here's the breakout point. We have a strong breakout. It fell below the breakout point. That's telling us that the trend is not strong. It's not forming gaps, and that bears selling above prior highs and scaling in higher can make money. And that's what they'll continue to do. Every time it goes above a high, they'll sell. 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 Goes above a high, they'll sell again. When the bulls see deep pullbacks like this with a series of bear bars, they're less confident in the trend, and therefore they're more interested in buying pullbacks and less interested in buying at new highs. Did the bulls buy above this high? Not really. Did the bulls buy above this high? A big tail here, a double top. Not many bulls bought up here. Mostly bulls were taking profits, and bears were selling. Bulls prefer to buy pullbacks when a channel is broad like this, and they tend to sell at new highs, take profits at new highs. The bears see this as well, and they're looking to sell new highs and scale in higher, confident that there'll be another pullback deep enough for them to make a profit. Bears can either sell with a limit order at the prior high, or they can sell on a reversal down. Here, this bear sold with a limit order at that high, and you get filled right here. Some bears will scale in higher as long as the second entry is at least as big as a minimum scalp. The minimum size scalp in the Forex markets is 10 pips, so some bears will sell this high and sell more 10 pips higher. Some traders prefer to enter with stops, and they'll sell on a reversal down, like below the low of the prior bar, like below that bar, or below this bar, or below this bear bar. Some bear scalpers, if they sell at this high and 10 pips higher, they'll exit at the original entry price, getting out break even on their first trade and with a profit on their second trade. Others will not take the first entry. They'll simply start selling 10 pips above and 20 pips above if they can. And then they'll either take profits at this high, or they'll look at the size of this pullback and conclude this pullback will be fairly big as well, and they'll look to take profits lower down, maybe 20 or 30 pips profit. Some bears will hold for a swing down and only get out on a reasonable buy setup for a reversal up. Double bottom here, micro double bottom. As a trader, you're constantly trying to decide what the probability is for the next several bars. Is it 60% probability up? Is it 60% probability down? Is it 50-50? Here we have a wedge bottom, 1, 2, 3. 3 reversals up, 1, 2, and then a bull bar here for 3. It's a small wedge bottom, but a lot of the bars here are bull bars closing above their midpoints or at their highs. That means there's probably at least a 60% chance of at least a little bit of a rally up maybe to the top of this tight trading range. Therefore, bulls will buy above the IOI, an inside bar after an outside bar, or they'll buy with a stop above a bull bar, above this bar or above that bar, and get filled right here, looking for a scalp up. Once they see this, bull bars getting bigger, 1, 2, 3, 4, and now closing on their highs, they're confident that this breakout will lead to some kind of a measured move up, 60% chance, and therefore some bulls will buy the close of this bar and put a stop down here, confident that the market will go up enough for a profit before it comes down here and hits a stop. Always in long at this point, maybe even at this point, but certainly at this point, always in long. Odds are we're going higher, and the stop is below the bottom of the bull trend. Second leg up, likely. When the market's in a broad bull channel or in a trading range, there's going to be bad follow through after a breakout to a new high. And that's why it's a broad channel. It goes to a new high, and you get a fairly deep pullback after the new high, and that creates a broad channel. We have a bear breakout. If you want, you can simply call it a bear reversal, but it's certainly a bear breakout below this trend line, which I do not have drawn. And we have 3 consecutive bear bars here, 5 out of the past 6, and we have a wedge top, 1, 2, 3. Odds are we'll get at least a couple legs sideways to down. Maybe 60% chance of some kind of a measured move down based upon the height of the bear breakout. If you're a bull, you see the break to a new high, and this is terrible follow through for the bulls. Very disappointing. Different ways to draw the wedge. You can draw it here. Some bulls will exit here. Others will wait for a second entry sell and then exit on the second entry sell, either below this bar or below this bear bar or here. a small double top, a small lower high. Some traders will rather exit only if they see a huge bear bar or two very big bear bars or three smaller bear bars, and then they'll exit on the close of that third smaller consecutive bear bar. The bulls are exiting, and if the bulls are not buying, the bears know the market's probably going lower, and they'll sell exactly where the bulls are exiting. At this point, we have 5 consecutive bear bars, 4 of them closing near their lows. The market's always in short. Some traders, it's always in short here on the third bear bar. Others will wait for 4 or 5. That means the odds are we're going at least a little bit lower. A tight bear channel, it's a breakout on a higher time frame chart. Probably will get at least a small second leg down. It's still above the bottom of the bull breakout, but it's big up, big down, big confusion, and therefore probably a trading range. Or if it forms a higher low, it could be a broad bull channel as well. And then we broke below the bottom of the bull breakout, but not below the bottom of the bull trend, and we reversed up violently. That's telling us that the market is probably going higher, and we have a higher low, so it's a bull trend. We have a very deep pullback. It's probably a broad bull channel. The bears, if they sold here or here, would take their profits above this bull bar, and a lot of the bulls would buy again, hoping for a higher low and a broad bull channel. The bulls can buy either for a swing or a scalp. At this point, they don't know if it's going to be a trading range, in which case they would like to scalp, or a trend, in which case they would like to swing. Some bulls who buy will scalp part and swing part until they're confident that the market is in a trend. By the close of this bar, there's a 60% chance that we're going up for some kind of a measured move based upon the height of this bar, maybe from the open of the bar to the close of the bar. That means the target might be somewhere up here. By the close of this bar, most traders conclude that the market is back to always in long. In other words, likely to go higher. And that's what it did. We went up for a second leg, but it's still possibly a broad bull channel, which means a breakout to a new high will probably be followed by a deep pullback. Rather than buying here, some traders prefer higher probability trades, and that means they wait for a very strong breakout, and they'll buy that close. They'll buy with a limit order at the low of the reversal attempt, especially since the bear bar did not close near its low, or they'll buy on a stop above the II or below the II, betting that it's a weak short and that we're still probably going higher. Once you see a very strong reversal up like this, the odds are it's going higher. If it falls below this low, then your premise of higher prices is probably wrong, and therefore it's reasonable to put a stop right below the low of this bull reversal. At this point, we have another high. You can call it a wedge if you want. 1, 2, 3. Does not have a wedge shape. You could also call it an expanding triangle. In any case, it's 2 legs up, 1 pullback, 2, in either a broad bull channel or in a large trading range. The bulls will take profits. We have a micro double top, either here or here below this lower high. And the bears will sell as well. They might sell for a swing because it's an expanding triangle top and it's 2 legs up. This might be a second leg trap in a broad bull channel or in a trading range. So there might be enough room for a swing down. This is the same chart, and it's showing what took place after the bull channel ended. At the end of the session, the market became very quiet and entered a very tight trading range. We had an expanding triangle top here, and then it evolved into a larger wedge top here, 2 legs up, 1, pullback 2. You can call it a wedge 1, 2, 3. Third leg had a small double top in it, a small final flag. A lot of the bulls, most bulls, would get out below this bear bar closing on its low. We have a wedge top, we have a final flag, we have a micro double top, up, down, and a bear bar closing on its low. Some bears might scalp and take a chance that they can make money, but we're right at the end of the US session and we'll probably soon enter a trading range. Strong bear breakout, follow through, consecutive big bear bars, always in short, but once you start to get very small bars at the end of the US session, the market's probably going to go sideways in a tight trading range. Rather than selling down here, traders would be looking to take profits had they sold higher. They might sell, but once you enter that tight trading range, they're going to take profits or just exit around break even. It's always useful to be able to diagnose what the market is doing as early as possible because your risk is less and the profit potential is greater. In a broad bull channel, the pullbacks are very deep and they overlap breakout points. There's usually enough room for bears to make money selling rallies. There's also bad follow through on breakouts to new highs, even if the breakouts are strong. The bulls are selling to take profits above prior highs, and the bears are selling to go short, expecting at least a scalp down and possibly a swing. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bull channels.